The world's most successful investor, Warren Buffett, is sitting on a mountain of cash, $280 billion to be exact. At the same time, he's selling off massive chunks of his prized stock holdings faster than you can say Berkshire Hathaway. Buffett's favorite market indicator is flashing red, warning of potential overvaluation. But what's really going on? Is the Oracle of Omaha preparing for a market crash? Or does he have something else up his sleeve? Let's dive in and find out. As of the latest reports, Berkshire is sitting on a mountain of cash, approximately $280 billion in cash and cash equivalents. To truly grasp the magnitude of this figure, we need to put it into perspective. Back in 2016, Berkshire's cash position was around $50 billion. At that time, this was already considered a substantial amount for any company to hold. Most businesses prefer to reinvest their cash into growth opportunities or return it to shareholders through dividends or stock buybacks. But Buffett has always marched to the beat of his own drum, and even then, $50 billion in cash was seen as a strategic reserve. If we go further back to 2008, during the height of the financial crisis, Berkshire's cash reserves peaked at about $44 billion. This war chest allowed Buffett to make some of his most iconic deals, including investments in Goldman Sachs and Bank of America, which later proved to be incredibly profitable. At the time, $44 billion seemed like an enormous sum, providing Berkshire with unparalleled flexibility during a period of market turmoil. Now fast forward to 2024, and we're looking at a cash hoard of $280 billion, more than 6 times the amount Buffett held during the last major financial crisis. To put this into perspective, this cash pile is larger than the GDP of many countries. It exceeds the market capitalization of corporate giants like Coca-Cola or Disney. It's a sum so large that it's difficult to fully comprehend. But why is this significant? Warren Buffett has always emphasized the importance of having cash on hand. He famously said, "Cash is to a business as oxygen is to an individual. Never thought about it when it's present, the only thing in mind when it's absent." This quote underscores Buffett's belief in the strategic value of liquidity, especially during times of market stress or when unique opportunities arise. However, Buffett has always been clear about the drawbacks of holding too much cash. He's stated numerous times that cash is a bad long-term investment due to inflation eating away at its value. So Buffett's willingness to hold this much cash, despite his own advice about its long-term drawbacks, suggests that he sees compelling reasons for maintaining such a large liquidity position. Adding to the intrigue of Berkshire's massive cash position are Buffett's recent stock sales. These moves have been particularly noteworthy because they seem to go against Buffett's typical buy and hold forever strategy. Perhaps the most surprising of Buffett's recent moves has been the reduction of Berkshire's stake in Apple. For years, Apple has been one of Buffett's favorite investments. Often referred to as one of the 4 giants in Berkshire's portfolio, Buffett has repeatedly praised Apple's business model, its strong brand, and its ability to create customer loyalty. However, over the past year, Berkshire has sold a significant portion of its Apple holdings. In the second quarter of 2023 alone, they sold over 389 million Apple shares, nearly 10% of their position in the tech giant. This move raised eyebrows across Wall Street, given Buffett's long-standing enthusiasm for Apple. It's worth noting that despite these sales, Apple remains Berkshire's largest single stock holding. The sales could be seen as a way to rebalance the portfolio, given Apple's strong performance and growing proportion of Berkshire's overall holdings. Nevertheless, the size and timing of these sales have fueled speculation about Buffett's outlook on the tech sector and the broader market. Berkshire has also been reducing its exposure to the banking sector, an area where Buffett has traditionally been heavily invested. Notable sales include portions of its stake in Bank of America and U.S. Bancorp. These moves are particularly interesting given Buffett's long-standing affinity for bank stocks. He's often praised the business model of well-run banks, citing their ability to gather low-cost deposits and lend them out at higher rates. The reduction in bank holdings could signal concerns about the sector's future profitability in a changing interest rate environment, or it might reflect broader economic concerns. In one of his most dramatic moves, Buffett completely exited Berkshire's position in 4 major U.S. airlines: Delta, American, United, and Southwest in 2020. This decision came during the height of the pandemic uncertainty when air travel had ground to a near halt. What's notable is that Buffett hasn't re-entered these positions despite the recovery in air travel. This suggests that his concerns about the airline industry might be more structural than cyclical. While we can't know for certain what's going through the mind of the Oracle of Omaha, we can make some educated guesses based on his past behavior, current market conditions, and Buffett's well-known investment principles. Reason number 1: overvalued market. One of Warren Buffett's core investment principles has always been to buy undervalued companies. He's famously said, "Price is what you pay, value is what you get." In the current market environment, finding value has become increasingly challenging, especially for an investor of Buffett's scale. The stock market, particularly in the United States, has been on a remarkable bull run for over a decade. This extended period of growth has pushed valuations to historically high levels, especially in sectors like technology. The Buffett indicator, a metric Buffett himself has praised as a good gauge of overall market valuation, is currently flashing warning signs. This indicator, which compares the total market capitalization of all U.S. stocks to the country's GDP, is currently sitting at around 195%. For context, Buffett has suggested that a ratio above 120% indicates an overvalued market. At nearly 200%, we're in uncharted territory. Given these high valuations across the board, Buffett might be finding it difficult to identify investments that meet his strict criteria for value. His large cash position could be a reflection of his unwillingness to overpay, even for high-quality companies. As Buffett once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Right now, he might be seeing too few wonderful companies at fair prices. Reason number 2: preparation for market downturn. Buffett's massive cash reserve could be seen as preparation for a potential market downturn. Throughout his career, Buffett has emphasized the importance of being prepared for market corrections. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." By holding a substantial cash position, Berkshire could be well positioned to take advantage of buying opportunities if a significant market correction occurs. This strategy worked well for Buffett during the 2008 financial crisis, allowing him to make profitable investments in companies like Goldman Sachs and Bank of America when they were undervalued. Buffett has always viewed market downturns as opportunities rather than threats. The current cash hoard could be Buffett's wash tub, ready to collect opportunities when the market eventually turns. By maintaining such a large cash position, Berkshire ensures it has the dry powder needed to act decisively and quickly when attractive investment opportunities arise. Reason number 3: economic uncertainty. Another contributing factor to Buffett's cautious stance could be the global economy, which is currently facing several uncertainties. First, inflation concerns and rising interest rates have been at the forefront of economic discussions. After years of low inflation, recent data has shown significant upticks, leading to concerns about its impact on company valuations and consumer spending. Then, the geopolitical tensions, including conflicts in Ukraine and the Middle East, add another layer of uncertainty to the global economic outlook. These conflicts can have far-reaching effects on global trade, energy prices, and overall economic stability. Ongoing supply chain disruptions initially triggered by the COVID-19 pandemic continue to affect various industries. These disruptions can impact company profitability and make it more challenging to assess the true value of businesses. Finally, potential real estate market instability, particularly in China, is another area of concern. Given China's significant role in the global economy, issues in its real estate sector could have ripple effects worldwide. These factors combined create a complex and unpredictable economic environment, Buffett's cash hoard could be seen as a hedge against these uncertainties, providing Berkshire with the flexibility to navigate potential economic challenges. Reason number 4. Waiting for an elephant-sized acquisition. Buffett has often expressed his desire to make an elephant-sized acquisition for Berkshire Hathaway. In his 2018 letter to shareholders, he wrote about the difficulty in finding large companies to acquire at sensible prices. With $280 billion in cash, Berkshire is well positioned to make a major acquisition if the right opportunity presents itself. The large cash reserve gives Buffett the flexibility to act quickly when a suitable target becomes available. Buffett has always been patient when it comes to making large acquisitions. He's willing to wait for the right opportunity rather than make a suboptimal deal. As he once said, "I don't look to jump over 7-foot bars. I look for 1-foot bars that I can step over." The current cash position could indicate that Buffett is still on the hunt for that perfect elephant-sized acquisition. Given Berkshire's size, only a very large acquisition could meaningfully impact its results, which limits the pool of potential targets and requires substantial cash reserves. Reason number 5. Changes in Berkshire's business model. As Berkshire Hathaway has grown, its business model has evolved. The company now owns many cash-generating businesses outright in addition to its stock portfolio. These wholly owned subsidiaries, particularly in the insurance sector, require significant cash reserves to operate effectively and meet regulatory requirements. The growth of Berkshire's insurance operations, in particular, necessitates holding more cash to cover potential claims and meet capital adequacy requirements. Insurance companies need to maintain substantial liquidity to pay out claims, especially in the event of large-scale disasters or unexpected events. Furthermore, as Berkshire has grown, its investment strategy has had to adapt. The universe of companies large enough to meaningfully impact Berkshire's results has shrunk, potentially leading to a buildup of cash as suitable investment opportunities become scarcer. Warren Buffett's moves are closely watched by investors worldwide, and his current positioning could have significant implications for the broader market. The Oracle of Omaha's decisions often influence investor sentiment and can even shape market trends. Buffett's actions send a strong signal of caution to the market. His large cash position and recent stock sales, particularly of long-held favorites like Apple, suggest that he sees the current market as overvalued. This cautious stance from one of the world's most successful investors could lead other investors to reassess their own positions. We might see a ripple effect where both institutional and retail investors increase their cash holdings or become more selective in their stock picks, mirroring Buffett's conservative approach. This shift in investor behavior could potentially impact market dynamics. If a significant number of investors follow Buffett's lead and increase their cash positions, it could lead to decreased demand for stocks. This reduced demand might put downward pressure on the market, potentially triggering a correction or even a more substantial downturn. However, it's important to note that the market is influenced by numerous factors, and Buffett's actions alone are unlikely to cause a major market shift. On the flip side, Buffett's strategy suggests that he expects significant buying opportunities in the future. His willingness to hold such a large cash position indicates that he anticipates a time when valuations will become more attractive. For astute investors, this might be a cue to start preparing their own strategies for capitalizing on potential future market dislocations. What do you think is the primary reason behind Buffett's cautious stance? Is it market overvaluation or economic uncertainty? Or is he waiting for that perfect elephant-sized acquisition? Share your thoughts in the comments below, and don't forget to subscribe to the channel.